I'm guessing that you want to become a profitable trader. It'll be really hard to do that if you can't master these two concepts. That is liquidity sweeps and fair value gaps. In this video, I'm going to give you the simplest and most straightforward explanation of these two concepts. You'll be able to start trading immediately by the end of this video. And on top of that, you'll get to see a live example of me trading these two concepts, just so you know that I practice what I preach. Again, I'm assuming that you want to become a profitable trader, but if not, feel free to click away from this video. So with that, let's stop wasting time and let's jump right in. First thing first, make sure that you're paying close attention to each stage of these concepts because each concept builds upon the next one. So if you really want to make sure that you're getting the most out of this, make sure you're understanding each stage. Don't feel bad to rewind and watch again so that you can really get it. So let's start off with understanding market structure. So why do we need to understand market structure? Well, market structure theory tells us that price is always in one of three stages. So price is either in an uptrend, right? We're either consolidating or we are in a downtrend. So that's what we can see on the screen that's happening right now. Clearly, in an uptrend, we wouldn't want to be selling in an uptrend, right? If we sell down here and price is going against us, well, we're losing money, right? And then in a downtrend, we wouldn't want to be buying, right? Because if we buy right here and price is going down against us, then we're also losing money. And then we wouldn't want to trade much in a consolidation period either, because really we see the gist of it. Price is going up and down, but the gist is we've really gone nowhere. So you want to pay close attention to what state of the market that we're in, because that's going to dictate how we're trading. So what makes this an uptrend? Let's understand this first. So why is this an uptrend? So first, go along here and see that we have put in a low right here with price. There's a low right here. Price has started off right in these areas, right? And then all of a sudden we put in this high and then we put in another low. So this low now is a higher low than the previous low that we were at right here. So now something is changing, right? For some reason, price has gone down to this area, but no longer wants to go as back down, further back down in this area. So we are now in a uptrend because as we continue to see, right, price actually goes in and puts in also a higher high. Now, what's the big deal about this? Well, price, same thing, has put in a higher high and for some reason does not want to put in a high up in this level anymore. We're not at this level. We've now surpassed it and gone to this level. And then we watch down here, a higher low again ensues, higher than the previous low that was right here, and so on and so forth. So that is how we know that we are in an uptrend. The downtrend side of it is pretty much the same thing, just flipped around. We have a high, then a low, and then a lower high, right? And then a lower low is put in. So this low here is lower than this low, and this high here is lower than this high, and the following high is lower than the previous high. So that's how we know that we are trending downwards. Very key and very important to know what states we are currently in. And guys, don't think for a second that any of these concepts that I'm sharing with you in this video aren't transferable. All of these concepts can be used either in the futures market, the Forex market, or in the stock market. And if you're looking for a way to be able to beat your returns, go ahead and check out our partners at Liberty Signals. They offer a no discretion, no stress way of swing trading. They also share their 64% returns since 2010. They've been doing this for over 14 years at this point. They show you where to enter, where to exit. They show all their public results. They share all of that, their profitable trades publicly on their website. And this year, they actually boast a 102.47% return on your initial investment. Go ahead and get yourself a 3-week trial using the link in our description. But anyways, let's get back to the video. So what is happening when we are in these uptrends? Let's break this down a little bit further. So as we can see here, price is pushing up forward. This right here is called an impulse, a bullish impulse. And this over here is called a correction. So we go against price a little bit after we impulse to the bullish side, and then we have another correction, then a bullish impulse again. The interesting thing about these impulses is that typically when an impulse occurs, more than likely we leave behind a gap. And that, my friends, is called a fair value gap. Now, I have a whole video about fair value gaps. I can link it in this video. You can see it on the screen. And that really goes in more detail about what fair value gaps are, how to use them. But for the purpose of this video, we're just going to identify the fact that a fair value gap was formed. And these fair value gaps are really what helps price really move on in these uptrends and in these downtrends. Pro tip, you can tell what trend we are based off of how price is respecting your fair value gaps. If we have a fair value gap right here and price ends up coming right here, it'll end up using that fair value gap often as a place of support. So we'll support this area right here before we go on and create the next impulse move. So you can start to see why it's so important to know where your fair value gaps are, because you can get in on these impulse moves, and these impulse moves can be really, really big moves that you can take advantage of just by noting where your fair value gaps are. The same thing happens over here on the bearish side. Can you tell where the fair value gap is? It's right here. All right, so price creates a fair value gap. Let's, for the purpose of this video and simplicity's sake, let's put this previous high over here, and fair value gap is here. Look how price is respecting the fair value gap. We tap it, and then we continue with the next impulse range. Then we correct, and then we impulse again. So very key thing to note here, fair value gaps and impulses, so key for our trading. So we need to understand swing highs and swing lows, right? Why do we need to know that? Well, the thing is, as traders, we need to understand what other traders are doing, because that generally impacts the way that we trade. Why? Well, many traders trade different strategies. So we know that at a swing high, more than likely, we'll have a certain level of buyers in the market at different levels, buyers or sellers. So when a swing high is formed, we'll have most likely different sellers in the market right here. So we'll have sellers. When a swing low is formed, we'll have buyers in the market. All of these players are entering the market, and you know, they've all followed common advice. More than likely, when you enter a trade, you're going to have to put a stop somewhere. And your stop isn't going to be, you know, you're not going to leave your stop like right here or anything like this. If you enter on the trade, you're not going to leave your stop like right here or anything. You're most likely going to leave your stop right here. And if you are buying right here, you're going to most likely have your stop around these areas as well. So just the key thing for us to note right there as we move on into the next part of this video. So as we move on to discussing liquidity, we need to know what the key narrative of the market is. We need to just be able to think for a second. As price is doing its thing, where are the stops? Where are the limits orders? Where are they all at? Are they going to be in the middle right here of all the price action? No, most likely they're going to be either on the highs or the lows, or as we talked about previously, the swing highs or the swing lows. That's where most of the stops are going to be, right? When thousands of traders are trading at the same time, there starts to become thousands of orders that are on the charts at the same time. So we might start to see stops over here, sell stops on the top, right? Looks a little messy, but I think you'll get it. And then we might start to see buy stops and buy orders, buy stops and other stop losses as well below. You know, we can think about maybe a support resistance trader. They're looking at where support is. Where is support in this picture? Where is resistance in this picture? They're looking at where all of these key things are. And that's where they're going to be putting their orders. They're going to be wanting to enter as price comes down to these levels, right? When price comes up to these levels, depending on whatever way they're trading, whether it's right or wrong, there's going to be orders that are all lying in one spot, and that creates liquidity. So your job as a trader is to spot these invisible orders and use them as your liquidity. So building on the last image, we can see here that with the collection of orders and below this and above this, price really needs to swoop up liquidity. We need to have some liquidity sweeps for price to be able to move around. Price gathers pretty much power. You can look at it as fuel. Liquidity is the fuel of the market. So when we are down here and we finally take the liquidity that's up here, we take all the orders that are in here, it gives the market the power to now go ahead and take the liquidity that is below here. Now, if the overall trend is a bullish trend like this, more than likely the program is going to be to finish out that bullish trend and start going and making new highs again. And that will only happen after a liquidity sweep. That's so key for us. And I want you to really make sure that you understand this, because that's really going to be the game changer for your trading. And you're going to be able to make a lot of money if you are understanding this concept. So let's look at a few entry models for trading in this concept. What is happening right here? So price is in a bullish trend, right? We come from here, we have a pullback, we have the impulse, then the correction, impulse, right? What's happening in this first part of this image, right? What is going on? Well, what we can tell, let me just draw this out here, because that's all we're focusing on. We're just going to focus on this area. Price has formed the fair value gap right over here, and then it used the fair value gap as support, and then it impulsed on that fair value gap, and then it went ahead, corrected, and then impulsed again. Now, not only are we, creating these fair value gaps along the way, we're also eating up a lot of liquidity. Most likely, we have some different forms of traders. You have the break and retest traders. They're looking for price to break a certain level, pull back, and so they can enter on that level. They probably might have orders around this area, and then, it gives price a little bit more power to push up to this level. Then same thing again, push up from this level and over here. A lot of traders who had their orders here could definitely have been thinking price was to go down, because you notice right here, as we come right here, price now pushes further. That supports that correction. That's what's fueling that correction right there. Again, fueling the correction right over here. So it wants to go down, but the overall bias, the overall program is to the buy side. But after a while of collecting all of these sell orders, price now has to correct, and it corrects a little bit. We balance back out to the fair value gap, right? And from that fair value gap, we collect more orders. More orders are being collected in this spot right here. More orders right here are being collected. So that now in turn fuels price to go higher. And again, at the same time as it's going higher, we have fair value gaps that are over here, right? We have fair value gaps that are forming right here that are being entered. They're orders that are being entered on those fair value gaps, maybe more sell orders, pushes the price of the market down back here. But then what happens? As we push out, people get out of those trades once they are reaching this level of support, right? And then they enter on a lot of other buy stops that were still here waiting for price to reach back here. So they enter right here and it lifts off price action. But at the same time, there are lots of orders on this way too. Thousands of orders in these levels and on these levels here. So price is eating up all these levels, and then it's pushing up right here. Now, after collecting all of these levels of price, of orders over here, different orders, it now has enough power to more than likely push down past this fair value gap, sweep the liquidity that is all on this level right here. Looks nice and messy, but sweep that liquidity and then push up to continue the program to the buy side. And that's really what's happening. So you can look at that as a opportunity to be able to get in on these trades. Whenever you see things happening like this, you can definitely take it as an opportunity and say that this is my entry model. This is what I want to see. I want to see a fair value gap formed. I want to see liquidity being purged, and then I want to look for that liquidity that's purged right here. You want to see this liquidity. You see most of the liquidity is setting down right here. That's purged. That's the lowest low that was stated right here, and then it pushes past it. Even this one that was over here, we're not really considering this too much, but it still pushes past that liquidity a little bit and sends the market higher. So that's how we want to look at the markets when we're looking for our entries. What I want to do is show you a trade that I actually took that was based off of this exact model, and how I was able to make over 6K on the day with that simple trade, with this simple model. So I'm going to show you guys that next. All right, so here's the recording of the trade sped up to around 4 times speed. I will be posting the full video, and you should be seeing the link on the screen or in the description of the video, of the trade, of all of that with the full commentary soon. So let me pause the video and let you see that this line right here is actually the demarcation of that liquidity to the left that's being purged. And then above my profit and loss statement, the 1025, you can see there's a fair value gap, and then that was also a key signal for me to get into the trade. Moving along with the trade, you can see that I eventually let the trade run a little bit more until I bring up my stop and allow myself to be taken out of the trade. I was pretty satisfied with my profit right there because I am copy trading on about 7 accounts. So every dollar amount that you see on the screen, you can multiply that by 7, and that is my total overall profit. So I didn't feel the need to continue to let this run against me. I saw this big pull up, and it was kind of an exhaustive move. And at this point, I moved my stop loss much closer to accept whatever the market gives me. So we take that profit, and that is the power of trading fair value gaps and liquidity. I hope that this explanation made sense to you guys. If there's anything that doesn't, go ahead and ask it in the comments. How about you? Did you guys make money today? How much did you make? Let me know in the comments. If you're looking for a more one-on-one hand-holding, fast-paced approach to everything that I know about the markets, go ahead and check the link out in the description. And thank you guys for making it to the end of the video. We'll see you guys in the next one.